Sailesh Bhan, CIO-Equity investments with Nippon India Mutual Fund joins us. Always a pleasure and delight to connect with Sailesh and get his thoughts in terms of where markets are headed, where margin of safety is. Sailesh, everyone is smiling this year. Do you think the smiles will last for 2024 as well?
I think the macro conditions have significantly improved, right? And policy continuity is also being anticipated by the market. So I think, and in addition to, the shift in oil prices and things like that, making things look good for India. The challenge is more in terms of the short-term expectations generally running way higher than what the reality is, because earnings need to still catch up. The core earnings need to start becoming more secular from here, and that is what will determine returns. Specific spaces do look attractive. The large cap space is very sensibly priced, but some other pockets are clearly pricing in everything going right for us. So I think 2024 looks good, but I think specifically for large cap space looks much better place there.
So, Sailesh, in this market, we currently have foreign institutional investors and they have got hit because of this millennial term, FOMO. For the year, foreign institutional investors are still net sellers, while domestic institutional investors were big buyers. If one assumes that the SIP flows will continue for 2024, so DIs will continue to buy, but FIs will come back. So what could be the scenario in 2024 where suddenly DIs do not want to sell because they've got SIP flows and foreign institutional investors want to come back because they are underweight?
So the foreign investor position has remained fairly underweight because of what's happened in their economies and reallocation to emerging markets through various, either indices or directly. Also, India has done exceedingly well, which allowed a lot of foreign investors to take profit away also in the last 12-18 months. The important thing now is from a geopolitical point of view, from a broader core economy performance point of view, India is doing relatively much better than most other places. So this will be the place where you will certainly find foreign flows gaining momentum. To your question, whether flows from domestic markets will continue and determine the trend later, I think even if flows continue, the reality is we will have to be conscious of right valuations or kind of constraint which valuations always put in. Though the expectations of growth remain to be positive, I think we are already pricing in some pockets of the market, especially the smaller cap businesses. We are virtually pricing in a very large amount of growth and longer term kind of growth horizons and strong growth over a longer period of time. So I think expectations at one level, in my reading, only flows don't determine real long-term returns for investors.
If the starting point right now is, let's say, 21,000 on the Nifty.
So they may matter from a 6-month point of view, or they determine.
I think there was a bit of an audio drop there. So Sailesh, small cap index this year has given a return of 40%. And small cap schemes and at least across the board mutual funds have given similar kind of returns in the small cap funds. What should be a very basic approach for small cap stocks for investors and even for SIP buyers in small cap funds?
So you've seen the strong returns which have come, right? This only by itself makes that segment a little more pricier. And clearly, we are finding meaningful, I would say, euphoric activity and sentiment in, say, below 5,000 crore, below 8,000 crore market cap companies, even within the small cap space, right? I think investors can choose to reallocate based on what ownerships they have in the small cap segment, because I think the momentum has been very strong there, the outperformance has been very strong there, and also valuations don't leave meaningfully long runway for returns in the near term. Also, the key aspect is you're also seeing significant amount of paper now coming about. Virtually every day there is 1, 2, 3 deals across categories, and this narrative that flows will determine everything. I think there are enough and more paper which is coming in terms of IPOs, offer for sales, promoter reduction in equities, promoter profit booking, as you may call. and which can have a lid in the small cap or tiny cap kind of categories. The core area to watch for is the 10 to 20,000 crore range market cap companies in small caps, which are still relatively better placed to handle the ups and downs of cycles which might come around. And there the valuations are possibly less frothier than the valuations below.
Sailesh, why is everybody excited about banks? And when flows have come back, banks really have not participated. I mean, just about every mutual fund manager, every institutional manager, every strategist, and now I'm seeing even television anchors also, that category included. All of us are of the view that banks have a good 2-3 year cycle. But yet banks have underperformed IT stocks in this year. How ironical is that?
Interestingly, yes, it's a trade which has not worked so much in the last 12 months. And for multiple reasons, some reasons could just be FI selling, some reasons could be specific developments in large banks which have, led to deferment in earnings. The reality is that space today remains the most attractive space within the large cap universe as well and within the broader markets. Even though you may have differences in near-term performances in certain sectors like banks and all that, the value they offer, the balance sheets they offer, and the investment cycle growth which is likely to come to about India, I think these guys will be material large participants. And where there is this kind of discomfort or this kind of pain point for investors, I think that is where value is available. See, where there is a lot of momentum already, you're finding that values are getting captured fairly quickly and kind of getting re-rated 30, 40, 50% in a month. But the banking space is very sensibly priced. Balance sheets are good. The whole cycle in front of them in terms of lending available to them. And I think the near-term challenges of high deposit costs and all that might remain for some time. But the risk reward clearly continues to be in favor.
Sailesh, we've spoken about a lot of themes in the past, and I would just remind our viewers that Sailesh has identified pockets like MNC Pharma, CRAMS. He took a big bet in Tata Group of companies after the turn of change of guard at Tata Sons. He, of late, last time when we met him, he said, look, India is young, but there are a lot of Indians who are aging. So invest in companies which would benefit because of the aging population. There are a lot of themes which you've identified, Sailesh. I remember them. So let's talk about some new themes for investment, which may be multi-year investment themes according to you, and not like India and GDP and all that. Proper themes.
See, there's still a lot of sectors which are young. The beauty of this country is that we claim that we've seen such strong growth, but I think we are still truly having many sector opportunities which are very young. So today, leaving aside the sub-segments which are very young, for example, logistics as a category, though very few players exist there, but I think this is one space which post GST has become a scalable, large, all India opportunity which is possible. So this is directly available to us. Second area is, while pharmaceutical might have seemed to have done well over the last 20 years, I think the same opportunity is as young as it was maybe a decade back, because the country itself is changing, the demographics are changing, the scale itself is changing there. Within manufacturing, or I would say the energy transition, the power side, the activity levels in India could be way higher and way different in the next 7-10 years. So that is one which will throw in a lot of activity on transmission, a lot of activity on getting the real design right in terms of the power networks which we have. And that is one area where we think growth will be outlier. So these spaces do appear to be extremely attractive. And the most commonly talked about the luxury space in India because of what's really happening in the upper end, the top 10% of India behaving exactly like how the high income countries globally behave. I think clearly that luxury market across categories, not just one space, is set to do extremely well and could become multiples of the size what it is today.
Sailesh, what about the consensus themes now? And the biggest consensus comeback theme is PSUs. You add a prefix PSU or a suffix PSU. Doesn't matter what the business is, the stock has done well. Do you think in PSU the re-rating is valid, or there is a lot of froth at play now?
So PSUs as a category were disproportionately undervalued till about a couple of years back, right? I think this valuation catch-up is happening. In PSUs also, there are certain categories of businesses which still have the right to win, those with extremely dominant market share or extremely monopolistic kind of business designs which exist, right? I mean, so there are certainly right to win, and certainly there is an opportunity there. Unfortunately or fortunately, the way the market behaves is, everything gets related equally. I mean, it's now more a PSU sector rather than a sector with this quality of a business or this ROE businesses. I think select banks in public sector still have material value versus where the market stands. And that is one space which we find interesting within the whole public sector pact, which is there.
Sailesh, there was a time when PSU banks were bailed out. Government had to infuse capital because they were on a verge of existential crisis. BOI has raised money via QIP route, and JNK Bank has hit the market. So the cycle has turned for PSU banks. And these stocks are still trading way below their private sector counterparts. Do you think for PSU banks, what started as a spark could ultimately be a very good rally for 24 and beyond also?
In public sector banks, the growth is still not there, and it's likely to come in the next 2 or 3 years because of the whole investment lending which will likely to happen. And that growth is certainly going to be rewarded by markets, because earlier the bigger issue was the banks have constraint for capital and we're not growing, and hence any level of valuation was unjustified in the context of the market. But today, with growth being back, these guys having capital and capacity to lend, which is not available, or it's very tough to find in other pockets of the market. I think this is one space where valuations still are very reasonable. Most of them are one-time book, and their ROEs have all started to improve and are now materially higher. So I think some level of re-rating in this category does seem probable, and certainly a better risk-reward space within the available options today.
Where do you think markets are mispricing growth, Sailesh, on the upside and also on the downside?
So mispricing is a function because there is so much of rapid movement everywhere, right? I mean, so you look at the constraints which, they're till about 3 months back or 2 months back, the narratives of macros were so different. So expectations of growth, either side, are moving fairly rapidly. There are select set of businesses which have not done well for 4 years because markets were already mispricing growth from them earlier. And I'm sure there will be disappointments in certain pockets of the market. It's very difficult to judge today, but I think equity earning expectations, at least in the shorter term, might be running higher, while the rural economy is not doing well, and these kind of constraints do put a cap, and the global economy not doing well do put a cap in terms of what can be the near-term earning potential of Indian companies. So I think your point that there can be mispricing on either sides, I think does exist in a market which is so buoyant, and that is what I think is, as investors and fund managers, is critical to watch out for in the next 12 months.
Let's talk about EVs. Now, EV is the real deal. 3 years from now, 10 years from now, both of us are reasonably confident that you would actually see more cars and scooters with a green number plate. वो हरी number plate वाली गाड़ी या scooter ज़्यादा देखेंगे. But somewhere from a market standpoint, do you think markets are pricing in 5 years of growth in 1 year?
There certainly has been some euphoria being built in, right, in select businesses, right? The transition generally is very, very large. So this kind of expectation of long-term change or transition, I think, will be there in the marketplace, especially when there is so much of buoyancy. You will certainly find certain leaders who will be able to capitalize on these much, much better. And the new market shares in EV versus what has been the ICE segment can be very different for different sets of players, right? So I think getting that call right is very important, because that will really determine how the longer term returns from select businesses will happen, or select companies in that particular space will happen. For the shorter term, yes, there has been a material re-rating which has happened in some of these businesses. The only thing I would want to be a bit careful about is, like, we have seen this sector not doing well for many, many years, the two-wheeler space in India. And I think it just started to rebound, and also having, in a way, a EV opportunity to be captured about. So I think it's a little too early to get to see this sector. I don't see this sector very expensive, to put it free, but I think because the cycle for them seems to have just started from a point of view of the regular business, because it's been flattish for several years. And the EV opportunity, you'll certainly get a few winners which are very different and which may have very different market shares than what they had in the earlier era.
Best way to bet on energy transition. Should one buy the existing players? I mean, Power is talking about energy transition. JSW Energy is talking about energy transition. Do you think the winners of the energy transition would be the existing power companies?
Clearly, the single biggest point in energy transition or winners for energy transition is access to right amount of capital and the discipline the managements have in terms of what type of ROE businesses they are going to take. We have seen even in the last cycle, people went or companies went ballistic and bought or invested in a lot of low ROE projects or projects which turned out to be extremely low ROE. I think businesses and utilities who have access to right cost of capital, and second point here being that their ability to stay disciplined and not just chase growth for the sake of growth. I think a combination of this will matter. And in my reading, there are a lot of select businesses with those, at least there are a few select business opportunities with those kind of, I would say, credible managements.
Up to the election, which is from here to 6 months, do you think your portfolio is going to change any incrementally?
No, I think directionally, I think the bet remains on large cap banks, larger amount of allocation to large cap spaces, because we think really sensible value lies there relative to other pockets of the market. And if you look at it, even domestic flows have been very limited on the large cap space in the last 12, 18 months. So there is limited or very little excess or less is excess in this particular category. And clearly that seems to be an important space from a risk reward point of view, even in the near term or even for the next 12 months as we see it.
Sailesh, now this is a tough year for IT. Headline was AI disruption, bottom line got hit, orders have come, they've not translated into transitions or translations. Yet the IT index has given you returns which are better than the Nifty and better than the bank Nifty. For a sector where the street is divided, why have we seen such good returns?
I think there are multiple things working, Nikunj. For example, if you look at it, IT as a space has massively underperformed. I mean, you're looking at Nifty as a reference, but significantly underperformed a lot of sectors. The whole engineering and manufacturing sector, even utilities and all have done exceedingly well. So there has been significant relative outperformance in many pockets of the market. So IT would have only outperformed maybe consumer staples and these kind of places, but there are a good number of sectors which are today trading at twice the valuations of IT services with maybe half the cash flow generating ability, right? So I think that is one put a floor in terms of where the valuations of the IT sector go, because even at very low grade, their growth rates, their cash conversion is very strong. So I think that is one piece. Second, the shift in the last few days in terms of expectations that the impact of interest rates globally will remain in this space and will not become even more difficult to operate, I think has led to a little bit of comeback, because there were a lot of investors who have been underweight in this space, given that near-term growth rates appear. So it's more, I think, a valuation adjustments. The recovery in growth is yet to be seen. And I think, like you said, there is a lot of mispricing happening in terms of growth versus where valuations lie. I think it is growth expectations are shifting fairly rapidly. So I think that space has come back more because of strong cash flows. It had underperformed way before the whole market rally started. And I think the bad news is starting to end there at the moment.
When you say manufacturing looks good, I mean, defense is also manufacturing, EMS is also manufacturing, auto is also manufacturing, everything is manufacturing. L&T says, I'm moving into manufacturing. Everything is directly, indirectly manufacturing. Mutual fund AMCs are also manufacturing. They're also manufacturing financial products. Manufacturing is sab jagah hai.
I think if at all there is a scope for manufacturing to become big in India, it is now, right? And I think there is every lever in place to do that. So from a scale-up point of view in manufacturing, there is a material opportunity. The single biggest problem in manufacturing scale-up is that it has to happen by putting in a lot of capital on ground. It takes a lot of time. You have to become a part of the supply chain, and hence this has to be a meaningfully long journey. It cannot be a 2-year change. Near-term manufacturing benefits are happening more on the energy side, the power side, the energy efficiency areas and things like that. To your point that whether every segment of the market will benefit within manufacturing significantly, I think we will be better off than what we have been in the near term or in the last 5, 10, 15 years. Scale, for example, is now getting critical in India. Today you cannot depend purely on an imported model to run your business here, because you may not exist if some shifts happen globally, and the risk of not having a local manufacturing base is paramount just for surviving and sustaining growth in India. So the fundamental levers are all there. The only big challenge is markets have re-rated them massively. So if you look at the specific areas in manufacturing today, there are businesses which are trading at 40 times, 50 times, 60 times operating profit. Even if they grow at 30% compounding for 3 years, the return expectations cannot be high from this space. So the business will feed into a virtuous cycle of growth if executed well, but we don't know whether there is a lot of money actually to be made in those spaces.
It's just been a pleasure to have you, and so nice to have your thoughts, and thank you for, in a sense, ideating and sharing with our viewers what are the themes and what are the ideas for 2024. Let's take a break. When we come back, while it's going to be Tata Power